And then Pierre, I think a lot of people in the room, I know we actually have one here that spoke at our CapitalCon event. They took a multifamily office out to dinner after the Super Summit, and they were able to raise, $50 million. The reason why they're able to do that is they had the pool of clients. And that particular multifamily office actually was open to direct investments. A lot of multifamily offices and RIAs that serve ultra wealthy as part of their portfolio of clients use a fund manager platform or multiple platforms, or they use an external consultant. So you have to get vetted and added to a platform, hopefully research approved on a platform. There's 2 or 3 layers sometimes to get that approval status. So I don't know if you could just shine a little bit of light for those in the audience who think, okay, spend 30% of my energy this year on raising capital from multifamily offices, because if I just win over 1 or 2, maybe I could get allocations to a percentage of their portfolio. Could you speak to how that works inside of your firm, and then just maybe a quick point on just helping people navigate the MFO space?
So this is really, I think you mean about sort of fund investments as opposed to direct private.
Right.
Yes.
Right.
Okay. So fund investments, we are we kind of take the view that you can't be expert in more than a couple of things. And we like to think our expertise is global asset allocation and portfolio construction of other investment managers. So we're not going to, put Apple stock in anyone's portfolio. We probably have a lot of Apple stocks through the large cap core or whatever category it fits in, managers we allocate to. We are also probably amongst the more conservative and less likely to end up in a small, really high performance new fund. In fact, truth is, we really don't do that. So, and that right there means most of you will never call. But our objective is 25-year time frame. We want to make sure that the cash flows are there for 25 years, that your kids and grandchildren get whatever benefit you think they should be getting or want to help them get. So we are going to lean on some of these big, dull consultants who you really don't want to trust, except they do ask a lot of really ugly questions that don't have good answers, but you learn something by seeing those answers. And so we go to a Mercer, you go to a Cambridge. We happen to be in partnership with Mercer, in fact. So if a small manager has not been looked at by Mercer, we will look sometimes, but I got to understand why. What is it about this manager that makes them any different? I got one a week real estate guy coming to me telling, I got great development opportunities in multifamily in Chicago. It's probably the 12th time I've heard that this year. So what sets them apart? Why would they be on our platform? We have about 120 managers-ish in all different asset classes. And most of them are pretty big, dull names. They're not likely to outperform, but net, we think our global asset allocation tends to give us a few bips of outperformance, if not more, over a 25-year time frame. So finding a reason why a newer, younger manager is any different is the starting point before we'll really go and look at some newer, younger guy.
And what do you refer to when you say a small manager? Are you talking about 20 to 70 million? Or are you talking about 200 million as small?
We probably really don't want to fall much below 100, 150 million in AUM. Right. And we really want to see a 4 or 5 year track record. So we have something to look at. Not that the track record means a thing about going forward, but it's evidence that at least you can implement whatever it is there may be evidence that you can implement what you claim you're going to do.
Okay. Let me comment on that, if I may. 2 most successful investments I ever made were with a guy in Philadelphia who was running $4 million and generated 12 years at 37 compounded. Yeah. And the next was with 2 guys, very smart guys, who a manager of a very large hedge fund in New York asked me to meet with because he said they were devastatingly bright, but they only had $7 million or $8 million, and he didn't want to be the first guinea pig. And so they came to my office in Princeton. They spent 3 hours with me, and I was absolutely convinced that they were tremendously bright. And so I gave them $500,000 on the spot, and then called him and said, you're no longer the first turkey, you're the second turkey to come in, because I gave them money. They did 27% a year for the next 10 years. I am a very major, not to be argumentative with my good friend here, I'm a very major proponent of small firms being the best place in the world to put your money. And recently, maybe 3 or 4 years ago, 2 finance professors at Yale did a 15-year study of publicly traded mutual funds. And in every single instance, every strategy, every niche, small managers beat large managers by an average of 250 basis points a year. Now, I can speak to you for 7 hours on why that's the case, but it is the case. It's irrefutable evidence. Small managers beat large managers at every single turn, in every strategy for every time period. But the reason they don't get money is because of job risk.
Yeah, go ahead, Tom.
Like I can only buy IBM.
No,
Job risk like that, you mean?
no, I'm not suggesting that at all. I'm just speaking
job
about
risk, you mean?
And I'm not speaking about job risk, because I understand, for you, I'm not speaking about job risk. Somebody told me that you're well cared for.
It's
But
it's why people hire big law firms. Nobody, a GC does not get fired for hiring.
That's right. That's right.
Yeah.
That's exactly right. Yeah. However,
And that's the business we're in, unfortunately.
there's one of the questions that's very relevant to that. And I've practiced it. When I started, I'm a pissant. I'm a small guy that nobody knows, okay? I make cold calls all day long to places with big pools of money and ask them for some of it. It's not noxious. It's sort of the American way. But everything I've done has surrounded me with big name firms. Why? Because when people start looking at me and who I am, if they see that I'm affiliated with big time firms, it suggests that, first of all, I'm spending the money to surround myself with strong allies, and that sends a good message. And then secondly, I beat the hell out of these people because they're charging so much, and I want them to give me discounts and allowances at every break because I am a pissant. Okay? So that's the way it works. There is a place for big firms, but you have to manage them. But in terms of returns, think of all of the people who became legends in the investment business from Buffett on down, okay? From Buffett on down, who started small. Now, if the mentality that exists today is, which we don't give money to small guys, Buffett would still be in a garage in Omaha running $32 million, and he wouldn't be known. And the same thing is true with dozens and dozens of managers, Steinhardt, Fine, and Berkowitz. They go all the way through the industry. The history of the industry is that small firms are the place to plant seeds. And those are the guys, because they're small, who can compound your money.
I agree with both of you, and I think there's a place for small firms and there's a place for larger firms. For example, our counsel, our law firm, you go to their website, it says we created the first hedge fund in 1949. That was us. We've used them since 1949. We have a great relationship. I mean, they're public about it, Seward and Kessel. So you turn around and you think of who they were when we started the relationship. I wasn't around. I have no clue, but I know who they are today. Okay. Then we have attorneys that are smaller and more niche in their practice. We custody with Pershing. So you look at our custodian, right? We went big there. We use ACA as an outsourced due diligence tool, and we also have an in-house CCO. So I think we've went big and small where appropriate. When it comes to managers, there are some big names in our portfolios. In fact, 6 closed managers, like I said earlier. Okay, and there are people may come to us for an access play. With some of those managers, people may come because they're in, a pool of 18 great managers. Okay, but I guess one of the best firm stories, once again, before my time, was we were a very early investor in a very large activist fund here in the city, and enjoyed over 20% returns for a significant period of time. Left with their lead analyst, and we were a day one investor in his fund. The performance has treated us very well, and that goes for another fund that they're relatively public about. We were one of the first investors in Tiger Tech, which is now Tiger Global, and a lot of great ideas have been sourced out of our Tiger relationships. That said, I understand why you allocate to larger managers, and especially when you're the guy that's going to hang if that client's investment goes wrong. I also think sometimes it's worth it to do and spend a lot more money on diligence to find those smaller, high-performing managers that may have the same Sharpe ratio as a larger manager out there.
So let me throw this, if I might, on his head and go completely off on a tangent, which we will not go any further into. But I just want to make an important point here. My ideal client, the kind of people I would like to work with, are actually business owners. And you and A.W. Jones long ago, and you yourself represent businesses that are themselves much more valuable than selling your business and putting it in the market. And that is what I try to do with clients who own businesses, is help them understand, how do I project that business as a viable, growing, successful entity down 25 or 50 years? Because that will be more valuable if I'm successful, which most often will not be, unfortunately. That will be much more valuable than taking the money out and putting it in the markets. And so that, to me, is the ultimate sort of risk mitigator. If you have a business, is to figure out how to keep it going, how to grow it, how not to flip it and take your money out and run, which is a perfectly fine thing to do. But a viable business being passed down to your grandchildren, in my view, is more valuable than the $100 million of equivalent being passed down to your grandchildren as cash.
Right. I think that's a good point. And I think most RIAs would rather see their client get a liquidity event so they can manage more of their assets. But I think it's a good point.